So, hello everyone. Welcome to Nimblbang webinar. And first of all, I would like to wish you all a very happy new year. Uh, this is and we have kept this webinar called Shubharambh 2024 as we are a start of the new year, and we have seen that 2023 the world economy has actually proved more resilient than most of us anticipated in 2023, despite the hurdle of inflation, rising interest rate, US banking crisis, and global geopolitical tension. Indian economy has shown remarkable resilience. However, stable inflows, which we have seen through SIPs, the most stocked inflow, reasonable macro stability, and strong earning in India has far ensured that India remain immune to global uncertainties. So let's usher in the new year with excitement and promise, symbolizing a Shubharam 2024 against the backdrop of India's thriving economic landscape. So the primary objective is to gain a deep understanding of navigating the stock market, to understand the factors going to impact in 2024, especially during the all-time highs, and with the ultimate aim of wealth creation. So today we have Mr. Neelesh Surana. I am sure you all must be aware about or know him very well. Uh, but just to give a small intro, so Mr. Nilesh Surana is one of the most celebrated fund managers, serves as CIO at Mirae Asset Investment Manager Limited. In his capacity as CIO, he takes care of the research and the fund management functions. He is with the Mirae since 2008, and if we'll talk about, so being a CIO, he is responsible for the fund managers activities, but standalone business, he is managing two funds. One is the Mirae Asset Emerging Blue Chip and Mirae Asset Tax Saver Fund. So without taking much time, so I'm just handing over to you to start with.
Yeah, thanks, Ritu, for a generous introduction and wishing you as well as your partners a very happy new year. Hope it brings health, happiness, and markets have been kind, so no complaints. And as you rightly said, the agenda, uh, we'll talk about the economy and the most obvious question, what to do in this market. We'll give our sort of view in terms of how things are sort of shaping up and why if I have to start with the summary itself, that despite the up move, we remain constructive and positive. And we have been positive all throughout last almost 2 years, despite various issues, what we saw related to commodity spike, interest rate spikes, etc. So I have a structured presentation, but I'll not go through all the slides, maybe few slides in terms of the discussion points, and I would have sort of a monologue for about 30 minutes or so. Subsequently, we can make it more interactive and do sort of a Q&A. So is this visible, if I may ask?
Yes, sir, it's visible.
Sure, thanks.
You can
Uh,
do the full screen of your presentation. Can you do
yeah,
that?
is this
Can you press
this is
F4?
visible,
Yes,
right?
it's visible.
Yeah. So what I was mentioning is that in aggregate level, see, the outlook is pretty solid, economic outlook, and certain portions, the market valuations have moved up, but overall the valuations are still reasonable. We have seen the worst of the interest rates. The election anxieties over post the state election outcome. Flows have been supportive. I mean, that's the broad sort of summary. And of course, commodity prices have sort of come down. So to that extent, as I said, that's the reason of the positive outlook. This is sort of agenda. I mean, some of these points which I mentioned, we'll discuss, starting with the structural longer term factors, that why The economy grew at 6.5% for last 2 decades. We think it should inch up in terms of growth. The macro factors, which is a low glide path of its fiscal deficit. Current account is comfortable. Inflation, interest rate worst we have seen is behind, and very strong external debt and forex. And some of the areas we'll just as go through the presentation in terms of the themes, flows, valuation, and the overall outlook. So let me start with the scorecard. I mean, 2023, as you rightly started with, has been no complaints in terms of how it moved up. Um, and by the way, that's a bit of fallacy in terms of predicting the market. Most experts at the start of last year, no one expected these sort of moments. So we also generally try to avoid giving a yearly view just because it's the start of the year, and I'll come to the reasons for that. But just we're looking at the scorecard, I think the biggest surprise for 2023 was the up move in the small and mid cap indices, which is almost 45%. Small cap, of course, 50%. In fact, small cap has a 3-year CAGR of 40%. Huge move in last 3.5 years in the mid cap. That's the biggest surprise. The large cap has been still catching up with the earnings, and this is the sort of scorecard. I think never ever in the history it has happened that any country has closed in green for 8 consecutive years. Any country, huh? This is just a summary of the emerging markets. So this is just one data point. I mean, normally we see that you have a couple of years of good years, you will have a bad year, but such is the resilience, and that's very interesting. I mean, to that, I will another give couple of more interesting data point, because just because we have completed 15 years in business, I remember in 2009, in the lows post global crisis, the Nifty touched a low of 3,000, and even China index touched a low of 3,000. After almost 16 years, we are where we are, 22,000, whereas China is at same level. And that's second thing. And third is our share of emerging market. I've asked it this further in the presentation has moved. So a lot has changed in the last few years, last 3-4 years, and market as a barometer is sort of reflecting the same. I will touch on 2-3 important macro discussion points, not much on that, and we'll directly come to the reasons why we are confident on the GDP growth and the market, thus constructive view on earnings. I think single most discussion point in terms of global macros has been the interest rate change, and over the last 2 years, I think perhaps one has seen the steepest interest rate increase, and you see US moving from less than 0.25% to 5.5%. It's a huge increase over the space of less than 2 years, and that was driven by different factors, different geographies, but it's more to do with sticky inflation, particularly if you're talking about in Europe, in US, on the services or the labor inflation. India has been much better in the overall context because our inflation is not led by services, also it's more led by the volatility in the food prices. Sorry, any issues? Sorry, I think there's some problem. Stop. It's okay. I think just some issue. My technology colleague is with me.
Yes. Sure, sure.
Sorry about this.
Yes, sir. Second.
Yeah. Is this visible, please?
No, sir.
Hello.
Yes. It's coming.
Is
One
it
second.
visible?
Yes, I can see now.
Okay. So I was talking about, I think the sum and substances, we have seen the worst of interest rate and inflation, and we would see rate cuts both in US and also in India. I'll come to that. My personal view is that in India, the inflation, core inflation, in fact, is at 43-month low. The volatility is more to do with food prices, with the commodity prices coming down. I think we would have inflation settling around 4.5%, 5% over the course of the next few quarters. In that context, we don't need 2 percentage point real rate. So I think that during the course of this year, interest rates will come down by about, say, 0.5% at least. That's so the worst is sort of over. In this context that we have seen, the world has seen unprecedented increase in interest rates and volatility, etc. India obviously is outlier, and everyone knows that our growth has been better than others. More importantly, is next 5-year growth as per IMF is also around 6.5%, which is again very solid, and the longevity of the growth is even more solid. We'll discuss that obviously. As I mentioned, that the core part of the inflation trajectory is coming down is very comforting. I think RBI is just sort of taking stock of what's happening globally and the volatility. And but over the course of this calendar year, I think 2024, my view is that interest rates will reduce, not much, but at least by 0.5%. And more importantly, peak of high interest rates or increase in interest rates is sort of over, which is very important for equities. Equity is the longest duration asset class, and they are very sensitive to the cost of capital. Other macro point is, as you know, that because of the war, I mean, Ukraine war, and of course, volatility, and now the recent war and other disruption, we've seen unprecedented increase in commodity prices in 2022, start of 23, and that has sort of come down. And India is very, macros are very vulnerable to oil prices. Now, with oil being around 80, I think it's very, very comforting, and we'll touch on that. Just coming to, I am not going much in macros and just come to the what we started in terms of why we are positive on the growth trajectory of the country. And I call out 5, 6 factors. Some of them are new, and some of them obviously are structurally positive, have been there, but they need the lubricant of reforms to fully capitalize on, let's say, demographics, potential in infrastructure, and we'll touch on that. Let me start with some of the newer factors. I think India's export, both on manufacturing and services, has seen a scene change over the last few years, last 3 years plus, both on manufacturing as well as services. And I'm talking about non-IT services. On manufacturing, I think it's a very different phase. It's a golden phase where it just started, and this theme would be there for next couple of decades. It takes a lot of time, but just to give why I have titled this slide Now or Never for India Manufacturing is for few reasons. First, there is an import substitution requirement by people who are sourcing from China for multiple reasons. Geopolitics, cost of labor is high there, and what happened during the COVID, and multiple factors. People don't want to 100% or 70, 80% or rely only on one country. And that's one tailwind, which is called China plus one. Second is labor cost has increased there. So all else being same, that also is the second reason. Third is government has put in the PLI scheme, which has been successful, work in few sectors. And lastly, is India is very interesting compared to other competing countries, which vie for the same, which will try for the same pie, whether it is Vietnam, Philippines, Indonesia, Malaysia, Thailand. Is that is such a large country that some on the consumer's good side, for example, mobile phone, you can make in India for the world as well as for India. And the classic case is mobile exports. It's seen literally skyrocketed from 23,000 crores to almost 1 lakh crore last year, and this year is much higher. Apple, for example, was exporting less than $1 billion, and then now run rate is almost $9 to $10 billion. But by the way, from China, via including Taiwan, what they source, the denominator is 150 billion dollars. So it's a very large number. But the point is, manufacturing push is there. It may take a bit of time. It may have ups and downs, but because of these 3, 4 reasons, along with reforms and the ease of doing business, I think it will accelerate significantly. The second point is what is mentioned below is that GCC, which is Global Capability Centers. So what has happened is after the COVID, the acceptability of remote working post-COVID increased, and that led to a bit of tectonic shift of large number of global jobs across function to India. So it's not only IT jobs, a lot of others adjacencies, be it audit, back office, a lot of functions, where people were not aware earlier that you can outsource, and that COVID, courtesy the COVID, it happened. So we have seen the global capability centers, or the GCCs, count increasing to 1500, which is basically global many MNCs setting up jobs here. And of this 1500, 500 has come only in last 3 years. And that is accelerating job growth, white collar job growth, and also helping our dollar earnings, forex earnings. It's almost 0.6, 0.7% of GDP now, and that is very positive. So both these points, if you look at manufacturing plus services exports, we have been a hub for IT traditional services exports, that remains at 230 to 40 billion dollar, but this additional thrust of non-IT services exports have also come in. The second reason why the cycle is sort of positive is that housing is a very large piece of the economy. And we have seen, after 10 years of lull from 2013, I think we are now in the third year running of upcycle. Last 1.5, 2 years have been good. And that's to do with stable prices, rising affordability, despite a recent increase in interest rates. And now with interest rates peaking out, affordability will be further okay. So what we will see is there is a reduction in inventory. Inventory as a system was almost 4.7 crore homes, which has come down to 1.7. And we have seen very strong absorption. And housing is not about one few sector or something like that. It is multiple businesses, whether it is steel, cement, building materials, paints, obviously financing of that. So almost 2.5, 3 crore jobs are directly, indirectly through various businesses involved in that, and almost uh, 2.5, 3 crore people directly, indirectly, and it's a very large sector. 70, 80 large businesses are there. But that's point number two, that heavy lifting of capex is done by government and the housing. Third piece is that the uh, that we have seen is, pre-COVID, we had a very bad patch of economic cycle. A lot of reforms were done. Banking balance sheet was fragile, and the peak was 2017, 18, 19. You can see the net NPA trends, and that has significantly improved. I mean, net NPAs are literally, incremental NPAs are literally zilch. Of course, it will mean revert, but this is courtesy the IBC and various reforms. We have seen very strong banking balance sheet as well as very strong corporate balance sheet. Corporate debt to GDP is, again, as you see, is literally a 10-year low. Banking sector NPA to over the last 10 years is again at 10 sort of year low. So what would this mean is that there is more confidence by bank to lend, there is more confidence of corporates to borrow, and more room for to borrow. So that would help the corporate cycle. The other point is in terms of consumption spend. Here we have talked about K-shaped recovery. All of you would know that the rural side is not doing well. So that's a bit challenging, but I'm sort of positive because simple fact that the base is low. In many cases, they have been not doing well for last 2, 3 years. So base is favorable. Government is supportive with election coming in. A lot of programs have been sort of stabilized. Construction jobs have come in, and I think it would revive. The point here is that over time, this is slightly longer term, this is not a near term thing, that over time, as the per capita income increases, you will see shift from uh, what is necessary essential items to discretionary items. We'll touch on that. Just coming, I'm going a bit to and fro, but let's just what is medium term and what is longer term, but just touching on some of the longer term trends. I think the reason why we should grow at probably closer to 7%, hopefully over the next, and definitely 6.5% as base case over the next couple of decades, is because of our favorable demographics, potential in infrastructure, which is nicely uh, lubricated by multiple reforms. We'll just touch on some of the longer term points, and I'll come back to the near term market scenario. On demographic, of course, all of us probably know that we are the youngest population with median age of 28, and this would remain very favorable all the way up to 2050. So we have a very strong working age population cohort, and in a scenario where worldwide we are seeing that there is a plateauing or reduction of the number of people working. So it's an aging population, including in China. Number of people who are working to number of people who are not working. And to that context, in that context, I think this supports the demographic. It has very long-term meaningful impact, provided jobs are there. The other point, again related to the first, is also uh, that's fine that people may be young, but is there a potential? The potential happens only if base is low. So in many of the categories, this is one indicative category, but many of the categories, particularly on consumer discretionary side, it's not on the consumer necessity good, but discretionary item, which could be basically all aspirational items. For example, in case of cars, the number of people who own cars, 1,000 in India is only 30. In China, it is 150. Air conditioners penetration is 5-6%. In China, it is again 60%. I'm not talking about US and all, it's much higher. Airline, again, a number of people is almost one third in terms of the density compared to China. And urbanization is, of course, also half of China, literally. The point I'm saying in so same ditto with the very areas e-commerce thing, is a longer term theme. As the per capita increases, we'll see a massive growth in growth potential in some of these categories. I talked about urbanization. Again, these are all slides related to consumer longer term theme, but it just says that where we are every decade we are adding point, I think around 0.7%, and long way to go. And urbanization has a huge impact in terms of earnings ability to spend, and on various goods you need home, you need a lot of consumer goods, and that lifts the overall GDP sort of growth. The another point in terms of uh, near to medium term trend, in fact longer term trend, is what for the want of better word is what we are seeing uh, is the formalization which is taking place, and that has been a lot of impact on the small and mid cap segment as we come later in the presentation. I think across sectors what we are seeing is large or maybe strong is getting stronger, weak businesses are getting marginalized, and there are many businesses which are a lot of marginal, weak, unorganized player which were having issues with tax. They were taking advantage of taxation, direct, indirect, etc. And with the advent of GST, with so many shocks in the system, with digitization, I think a massive consolidation is taking place, which is benefiting it. And particularly those sectors where unorganized is large, for example, building materials, for example, let's say footwear. So many companies are there, very few large listed companies are there, and many of those are mom and pop shops or unorganized players which are importing goods or not paying taxes or so. But with two things, one is GST and also the digital infrastructure. We'll talk on that. I think one of the most important reforms which has taken place in last decade is the digital public stack, which is what called DPI, where you have the identity system via Aadhaar, you have the payment system because of UPI, and you have the aggregator system for the governance. So these are the foundation blocks, and we are seeing the impact of that. Talked about online, etc. That's possible because now you can easily pay, etc. So Indian architecture of digital payment is well talked about globally. And for example, UPI started only in 2016. That was a watershed year where data prices came down, UPI started, and now we are transacting almost 980 crore transaction per month. So all of us know about it, but that's a massive thing that with identity, you have Jandan accounts. What could have taken 4 decades have been done in 1 decade with digital UPI free cost P2P. It's a game changer, and all this is helping the formalization. Some of the examples of this, I mean, these are medium term trends. Let's say groceries so unorganized, and you have likes of a big basket or some QC companies and all sort of coming in, or even formalization is happening in brick and mortars like what we see in the DMart, etc. Jewelry we see is getting massive consolidated among listed players. Similarly, the list is very long that all this is happening silently. and it's courtesy the reforms and courtesy the digital part of it. Apart from DPI, which we talked, there have been massive reforms which took place in last 7 8 years. Unfortunately, we are not able to get full impact benefit of it just because things were improving in 2020. We had COVID, so we lost 2 3 years for that, 2 years almost, and then we had war, which is basically war in the sense the Ukraine war and the impact on the commodity prices, and then the regime change in the interest rates. So we are yet to have a stable sort of environment of few years where you can capitalize on the good work done over the last decade, including the digital infrastructure. I think with stability in the government and next term and all, I think we'll see those period, and probably market as a leading indicator is part sort of showing that exuberance. The one of the piece I mentioned apart from demographics is on the infrastructure side, and government has been pursuing a lot of programs on the national infrastructure pipeline. Now, just coming to straight away to near-term valuations and the earnings trend. I think the data points on the high frequency side is almost very solid despite these disturbances. So from we take from pre-COVID to now, some of the larger indicators, which is GST, eBay, personal credit, are literally growing at 17 high teens or so. Some segment which is not doing well is your low ticket rural or low ticket even in urban areas. For example, two wheelers, many other segment. As I mentioned, the base is for multiple reason. I see things stabilizing and turning around over the next 1 year in this cohort, and hopefully K-shape would not be talked much. Uh, all in all, the earnings of corporate India has massively transformed. What was pre-COVID for top 500 companies, 4.14 lakh crore next year, which is we are just completing FY24. Let's say look at FY25, will be almost 4x, 15 lakh crores. So that's a massive growth in earnings over a 5 year period. And so the markets, what we see in terms of movement is based on fundamentals that earnings have also moved. Particularly in financials, we've seen a massive turnaround. So it's not devoid of fundamentals. Equally important is the earning cut cycle. What used to happen between 2013 to 2020, that you start with a particular EPS number, you end with a number much lower consistently for some excuse, reason, genuine or the other, the earnings cut were happening. Over the last few quarters, we are seeing that earnings are stable. So there is no massive cut. In fact, there is a time value attached and earnings are only improving. And as we see, as this show, this is Bloomberg consensus number that Nifty EPS is 1100. This is the 1100 EPS number. So we are trading on a large cap indices for next 1 year at around 19.5 times. And mid caps is trading higher at around 21 times. Coming to now on this, I think I would say that it's not cheap, but I would also not concur that it's expensive. The reason is if you see distribution of this 20 multiple, you have enough and more, almost 35-40%, which is around 15 times multiple. That is one. Second is the larger pieces of the large cap, giant caps, which is banking, IT is consolidated, consumer has not gone much, so it's not very expensive. What is expensive and have gone really high is some of the weaker businesses, particularly in the flavor of the season, which this time has been public sector, defense, industrials, etc. The reason why public sector or old economy businesses like power, utilities, defense, industrials, capital goods have gone so high is also to do with the base was very low. 3 4 years back, they were beaten down. You were getting literally रुपए की चीज 8 आने और 4 आने type, something like this. So the first phase was covering that, realigning the price to value to dollar, to aligning say 30-40 cents to a dollar, and now over the last few months or so they have gone high. But that doesn't that's at an aggregate basis is not very high proportion of the market. So they may be 20-30% of the market depending on which benchmark you are looking at it. So net I feel that despite the move, and this is the most important question, people say that it's moved too fast, too soon. I think particularly larger oriented businesses are cheap, reasonable, sorry, and that P multiples of price to book is not sort of obscene, at least to construct a sensible portfolio. There are large number of stocks and less number of total quantum, which may be there may be bubble or so, or there may be that should be covered in the construct of the portfolio. Markets are also a function of flows. So, few comments on that. We've seen zigzag flows, particularly from FIIs. The most important thing which has happened for the history of Indian market is the stability of domestic flows, courtesy the SIPs, which is around 17,000 crores. And now, with my view is that the investors which came over the post COVID, I mean, if you see it's literally doubled over the last 3 years SIP book, and the number of investors who have come in, now they are seeing a good outcome, good experience. So this I would not have said even a year back. So if you see 3 year return, it's pretty solid. And investors come with the time frame, mind frame of long term. So the SIP is the winning sort of part in terms of giving very stable longer term flows, which is very complementary to the FII flows. So I think and it's very sticky sort of money. By the way, from foreign money, I have a couple of observations that India has done well, extremely compared to other markets. And I showed a slide that we are the only country which has 8 years of. Last year, we ended with eighth year of back-to-back positive returns. Of course, this is not sustainable, but that's an interesting data point. What is more importantly is we were small compared to, this is only the emerging market index. This is not developed markets. Developed markets like US and all is excluded. This is only emerging markets, and mainly China was very large, almost 35% a decade back. And look at it now. I mean, India to China ratio was 6 times in 2013. Today, India has moved from 6% to 17%, and China has reduced from 35 to 22%. So the ratio is not even 1.5 times. So I think and that's the sort of a very interesting piece, that the importance of India has increased among emerging markets. By the way, last few years, we have not seen large flows in emerging markets. Particularly country funds literally vanished. It was all regional funds. So it's not that despite the market move, if you see FII ownership has reduced, what was almost 20%, 19%, even in 2021, it's come down to less than 17%. And as the dust settle on the interest rates, there are very few markets which would offer longer term good quality growth. So, sum and substance, there is a huge potential possibility of longer term, while there can be volatility of continuation of FII as well as SIP sort of money coming in. So, flows have been supportive. Just few comments on the sector is that we have, in terms of our current positioning, uh, uh, we this is our house sort of positioning. I mean, few funds could have different sort of weights. We still like banks, as I mentioned, it's among the cheaper ones. Very solid, clean balance sheet. A lot of restructuring, reforms and consolidation have taken place, and larger banks are relatively cheap. So that is a large portion in the portfolio. Pharma, we remain positive. It's Make in India. It's doing well. US pricing pressure has eroded less compared to earlier trends, and it's not so expensive. Consumer staples is slightly on the higher side valuation, but that is also as prime time corrected. Consumer discretionary is where we are super positive. Of course, here you have to look at valuations, and some cases valuations have come down, particularly those K-shaped rural low-end goods which have not done well in this market. So when the Nifty is what at these levels, you always have stocks which may be say at 15, 16,000 Nifty, and something can be 25, 30,000 Nifty. That's very important when we talk about market. Going forward, it will be very important to maintain discipline and buy businesses which have not probably done well in the past but will mean revert. I think consumer discretionary, chemicals, some of these names fall in that. So within discretionary, autos of course have moved up, but we are positive on that. uh, Auto ancillaries which are agnostic to EV, we are positive. New age businesses, again, we are positive. I think there's a long runway to go, but of course, each is different. We can talk on that in Q&A. Insurance is a steady business. Telecom, we have a pricing power coming in. Hopefully, post election, there's a consolidation of becoming two and a half players. So we remain constructive. It's a hold zone. FMCG, again, price and type correction has taken place. The valuation is slightly higher, but much more reasonable now compared to what it was earlier. Industrial infra is doing extremely well. So this is one segment which need debate, that this is a good business, but the valuation may be slightly on the higher side. So we have seen, at least I have seen in last 30 years, that good businesses, good momentum may not be good stocks. So now with the moment which we have seen recently, some of these cohorts are falling, that they are doing very well. Order book is good, margin trajectory is there, government thrust is there, but the valuations are not comforting. That's why I put in lower in the packing order. IT and metals are global linked. All I talked about global, that growth is coming down. So these are more tactical stock specific calls. That's on the portfolio positioning. So I think that's sort of broadly, sorry, one second. In terms of, if I were to, one second, please. If I were to summarize what's the view, it's uh, as I mentioned that uh, the longer term trajectory of growth of India has become even more positive. Uh, uh, and I mentioned that 15-year best corporate to GDP, the debt to GDP, banking NPAs, reforms, multiple things, both on absolute basis, more importantly on relative basis. No other country offer this trajectory, that going from 3.7 trillion to 5, then 7, then becoming literally top 3 economy in the world. And thereafter also there is longevity of growth for a couple of decades. So that longer term trajectory is sort of solid. And in the near term also, I did call out some of the factors of manufacturing traction, services GCC traction, formalization traction, recovery in rural because the base is low. All put together, earnings growth is decent. The point is that market, whatever I have been saying or so, I mean, obviously markets is a leading indicator and they have priced some part of it. I would sort of conclude that given where the valuations are, one should do three things. First is remain positive, constructive from a 3, 5, 10-year view. That doesn't mean returns don't come in near term. I mean, no one knows in equities the timing of the returns. The longer the view, the better the possibility of positive returns. Second is, so it's not negative that you go defensive just because it has moved up, because large portion giant caps are cheap. Second is keep the expectations low, because the starting point of valuations, everything is sort of decent, right? And you have some global uncertainty, you have consumer sector not doing well. So it's not that everything is hunky dory. And then, of course, we have the election event, you could have oil volatility. So volatility could happen. What could be the source of volatility? No one knows, but there is a possibility because the starting point of valuation is high. This is very unlike lows of COVID, that you can have volatility, but the valuation is low. There won't be. I mean, it will be uptick. So the point I'm saying is be positive on constructive of the equities, but have a longer term time frame, prepared for volatility, and have a lower expectation. So the expectation is okay, NAV will double in 5-6 years or 6 years, which is 12% CAGR on 5 to 6 years. I think markets will not disappoint, even from this level. But ideal would be to buy lump sum, not to continue with the SIP, and lump sum should be done in pure large cap funds. On this debate, I'm just taking a liberty on one question, which is there when I touched upon what to do in this market. I think sometimes mistakes always happen when the things are high. So the best thing sometimes to do is not to do anything, just remain disciplined, spread in systematic manner. If someone is overexposed to those sensitive sectors of small cap infra funds, reduce that and go in a normal diversified fund. But I think that there has tectonic shift taken place in the market cap landscape of this country in the last 3 to 5 years, where mid caps have become much more important and relevant. And if you see the latest classification which has come today, the small caps are the mid cap, the largest mid cap is now 67,000 crores, and the small cap is 23,000 crores. I remember this was the case that large caps were, I mean, 22,000 crores were earlier mid cap. Now that has become small cap. I mean, 250th stock is 23,000 crores, almost $3 billion. What has happened is I touched on a slide on formalization that lot of new businesses have been listed. Existing businesses have become big. For example, footwear, you are now 7, 8 companies. There were only 2 companies 10 years back. Hospitals and all has become a new segment because of new listings. So all these, and mid cap is only 100 slots. So you can't have more than 100, right? So, and of that is occupied by IT, BFSI, some of the large giant companies. So if you want full flavor of the country GDP growth potential subsegments cohort, you have to be in SMID, small and mid caps. Now the question is, some segment is expensive, yes, but that is, I'm saying, from a longer term construct, this is a new change. So I would personally recommend 50% large cap, 30% mid caps, and 20% small caps. Today one can be maybe 5-10% lower small caps in favor of this. The second point is, not only mid cap, there is giving you full exposure across sectors. The not only the choice, the scale has also moved up. So the larger mid caps, let's say top 20, 30, 50 mid caps, are literally equal to what large caps were 5 years back in terms of the scale of the profit. I'm not talking of scale of market cap only, because both are related. So net net, I would say that ideal would be to remain, the best product would be a multi-cap or a flexi-cap sort of fund. Flexi-cap, of course, is more large cap oriented, but which is okay today. And eventually you should be around 50, 30, 20 band. Important point is, the easy money is over in small caps. Everything has moved up. In a rising tide, lift all boats. So weaker businesses have moved more. So you have to be very careful which manager, which fund you are looking at. And risk is very important in small caps today. So ideally is either you invest more in large caps, or if you are choosing small and mid caps, look at managers who are taking contrarian call and not momentum calls. I think with that I pause and sort of chalu karna hai.
Thank you, sir. Thank you for giving us insights, of what we can expect from 2024 in terms of investments, in terms of economy and the markets. So very interesting. You have mentioned two things. One is while taking us on the valuation slide, you said the sectors related to old economy already performed, and there is still there is a scope that those sectors can perform well. And second, when you were showing the sector slide, you said that new age businesses you are positive. So both the old age economies as well as the new age businesses, where we can see lot many new listings are happening in the market across sectors, across various sectors too. So, can you just elaborate both the fronts, because these two ends are covering the entire space.
Yeah, so see, first of all, this timing, coining of the word new age, old age is all in the mind or the markets, because it's recent. What is new age will become old age. I mean, or what is business, right? Investing is investing. At the end of the day, business has certain ways to look at it: growth, ROI, cash flow. It's basically cash flow, whether it is coming from a digital or old. It's sort of the way to the investment, the way to invest remains same. Uh, and many of the old age business are not that, they're not digital savvy. Today, large banks are investing per annum 2.5-3,000 crore on technology, one single bank. So it's not that, it's a combination of brick and mortar and digital. What I was saying is, in the traditional so-called still old age or sort of larger businesses, basically some cohorts, which is banking, IT, consumer, these are still reasonable despite the rally. So which was almost 60-65% of the of the large caps, which is another 65%. So almost you have 40-50%, you have good pick and choose sort of thing. New age is separate because each is different. You can't compare a food tech with another food tech. Forget you comparing a food tech with a insurance broker or something like that, or an online thing, online broker. And so each is different, or a BPC online company or so. These are totally different business. What I was saying is some of these businesses, and we own about 4 or 5 in each of the funds, around 3-4%, and we have bought it in last 1 year, last 6 months in particular, not recent 6 months, prior to that, because I think there's a massive consolidation taken place. There's a 1 or 2 player market, very difficult entry barriers, so modes are there. Unit economics are improved. All of them after the IPO literally have improved compared to what was the expectation 1 year back or 2 year back, in terms of what they promised and what they delivered has improved. And the cash generation visibility is very high. And with such high, I think we like the context. Valuation was a challenge, but that also corrected a year back. So that's the time we bought it. So I remain very positive on some of the space. For example, food tech. These are businesses which would, as the India per capita increases, will have huge potential. This is purely linked to the GDP growth. So these are very longer term interesting businesses. Yeah.
Uh, Secondly, as we have seen in 2023, the strong DII flows. SIP is one of the more through which we have got a good flows in India. Uh, Contrary on a FII side, do you feel there are the multiple factors because of a monetary policy front, if we see, or there are multiple factors? There are, in terms of election, there are 50 countries are going to, election are going to happen in 2024. So do you see all these kind of factors going to impact on flows?
See, SIP flows I touched upon is sticky. Now with the experience being good, the only argument of domestic flows slowing down is that valuations are maybe higher. So people are thinking that it's moved too fast too soon. That's why. But SIP is even very longer terms. So that's okay, and that's a very large number. It's now almost $2.5 billion. It's much larger than what average FI does. On FI flows, because it's a SIP, it is easy to forecast. It's constantly moving up. FIA flows, Ritu, I would say is very difficult to forecast, and flows, lump sum and FIA flows are difficult to forecast. I doubt if anyone can forecast near-term forecast on flows. One can't say because interest rates will come down, it will come back, or the vice versa. And I have seen in the past it's futile to forecast. What is important is longer term, where will FIs go? They'll have to come to India. Again, the only argument is valuation is high. But from a 10-20 year perspective, will India get, say, about 20 plus minus $5 billion every year? Adjusted some year not, some year, some quarter not. Will we get that? Yes. In fact, it will be higher. So it will be positive. But if you're asking whether this calendar year will be negative or no, I don't know if, first of all, and I have a doubt anyone knows. Because last year also, who would have thought? Everyone was saying first half will be bad, second half will be good, something like that. But the movie turned around in March of last year. So it's very futile to predict near-term markets, and much more futile to predict the flows. In general, the shock of interest rate worst is over. So once things settle, money will look for growth, longevity of growth, and the options available are less. I mentioned about China, 15 years, no movement, multiple other softer aspects. You want your money back also, right? Return on capital and return of capital, both are important. People have anxiety there. Which is the next country? It's India. So hopefully, both FII as well as domestic flows can remain robust for significantly long period of time. That said, I mean, not, and now most of the factors, I'm not giving a very rosy thing, because volatility, just when we don't expect, volatility always hits. That's the reason to identify as I said, a balanced approach, which you guys sort of are expert in terms of asset allocation, and also, as I said, veer towards more tactically towards stable businesses.
Okay. One thing you have mentioned that we have seen on a last decade massive reforms, but impact that kind of that sort of impact we couldn't see just because of the 2020. We have seen COVID and all, and then post that the recovery and all. So, what sort of changes do you see in terms of economy, in terms of sectors, if we talk about?
No, I think the consensus estimate of economy growth, let's say if you look at FY25, consensus Bloomberg estimate is on the lower side. I mean, this is no science. If you're asking what could happen because of the reforms, there are always what happens is we may grow at 6.5% for a period of time. There are periods that you grow low, you optically go high. I could sense that post-election there could be period where we can grow north of 7% or so. The reason is generally during election, a lot of projects are announced and they are implemented after that. The second reason is worst of interest rates have taken place, so you'll have interest rates softening globally and in India. A third reason is some of the pockets which are not doing well, particularly mass market. There could be some stability during second half. So to your question that what could happen, I think is that we are yet to see the full benefit of reforms. Yeah. When I say full benefit, means there has to be a golden period of, say, at least 2 3 years of very high optical growth, and then they can sort of mean revert to say around 6.5%. Can we grow momentarily, as in like for few years, couple of years, more than 7%? Yes. Sure. Hello.
Hello, sir, can you hear
Yeah.
me?
Yeah. I can hear
Okay.
you. Yeah. Yeah.
Okay. So my second last question to you is: we are talk. There are a lot many talk about the demographic dividend in India. So different sectors can be benefited. So just to understand what kind of a sectors can be benefited by this, the India's demographic changes.
Yeah. So I mentioned there was a slide that I think the biggest beneficiary will be discretionary because demographic dividend along with per capita increase should be seen. So as the per capita income moves from 2,300 to as it moves up beyond a point, you don't invest in basic goods, soaps or detergents and some basic sort of stuff. You will invest in, sort of spend in more discretionary items. And today, a large portion of that goes into mobile, etc. But as it increases, as the aspiration level is high, demographic doesn't mean only age. I mean, it has to be given the jobs you have, urbanization trend, you have more women in workforce, there is proliferation of media, aspiration level is very high. Gen Z cohort needs to be sort of seen, and younger population along with gig workers, etc. All put, I think the biggest beneficiary to my mind will be discretionary, which will large pockets like autos. Some of the new age businesses are into that, food tech, etc. Multiple items. Wherever there is a combination of low penetration, which is, as I mentioned, all these ACs, etc. And of course, everything needs to be juxtaposed with stock price. If price is already built in, that doesn't mean that from a stock market perspective, it's a good sort of investment. But sector-wise, discretionary, and thankfully we are getting today is what has moved up in the recent times is industrials. So discretionary is still reasonable, yeah, in my mind.
Okay.
Sorry, Ritu, your voice is not
So my
audible. Yeah.
last question to you, in 2024, as you said, no outlook, but yes, we have discussed lot many factors which are going to impact on equity market. So as an investor, you have told that valuation point of view, what kind of a exposure one can have in a large cap, mid cap, and a small cap at this point in time, because we have seen a good rally in 2023 in terms of mid cap and small cap. So,
Yeah.
any sort of advice you would like to, or what kind of a, I won't say risk because I don't sound very negative, but yes, what kind of a factors one should keep in mind while investing? These kind of a factors can impact in
Sure.
2020.
No, one has to be careful. New money should not be put in small caps. New money should not be put in infra funds. This is my sort of view. Because even if you buy a diversified fund, it would have some infra exposure. Even if you buy a large cap fund, 20% is into small and mid caps. So it's not that you're totally missing it. But ideally, multi cap or flexi cap, I mean, large cap should be almost half to two-third, longer term half, but maybe now two-third. And there is a piece of froth in the market, which is flavor of the season, be it EMS, defense, some old economics, surprisingly tier 2, tier 3 banks, and some of things. So one has to avoid that. And the fund managers have to avoid that. So risk is very important in this market in terms of construct of the portfolio. Momentum can take these stocks further up. There can be a melt up. We have seen that in 1999. We have seen that in 2007. But that's not right. So it's important not to chase as past only past, because 1 year returns are covered for 5 year returns. Such has been the moment in the some of the stocks, which are not backed by fundamentals. So it's a nuanced subject, and that's the reason I think risk without being confident that India growth, confident on growth and all is sort of very important as the market keep on inching up in a bit of a rational manner.
Thank you, sir. It's not a very rosy picture, but I would say it's a very realistic picture you have given to us. A very few times we get it, such kind of a picture, where one can get a real advice what they need to do it. And I am sure the our partners and the investors definitely are going to benefit it with this outlook. And thank you for coming and giving us our time. And thank you on the behalf of Nimulban. So I would just
Thanks,
close this
Ritu.
session here only.
Yeah, thanks for
Thank you,
inviting.
sir.
Yeah.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.